fourth quarter. I am going to present to you a benchmark that you can use in the fourth quarter related to strategy and leadership. And you may have noticed in the composite book that there is a value of your business that's listed right below your revenue and your EBITDA. So that's what we're going to discuss today. Learn how to do this, put it in place at the end of every fourth quarter so that you can benchmark your value. So let's get started. So first off, I'm going to learn how to operate my mouse. There we go. All right. So first, what do I need to do? All right. So the way this works to calculate your value is we're going to first start by figuring out your EBITDA. Then we're going to adjust it. Then we're going to determine what the latest multiplier you should use is. Then we're going to multiply. And then any discounts or premiums that we need to consider need to be taken into consideration, right? All right. So first, figuring out your EBITDA. You're going to take your net earnings or your net income, whatever the smallest one is, and you're going to add back in taxes, depreciation, and amortization. That's the EBITDA of the EBITDA, right? Earnings before those things. So interest, tax, depreciation, and amortization. So once we adjust the EBITDA, then we're going to consider a couple of items. One is, what is our rent? Do we need to adjust it? So if it's fair market rent, i.e. you're renting from a third party, you don't need to do anything. But if you are renting from yourself, you might want to consider, are you overpaying to pay off a parent perhaps, or are you underpaying to help yourself with cash flow? We want to make sure that you're going to adjust that. And, rule of thumb, 4% at the low end, 8% on the high end for rent in the rental industry. Is your compensation as an operator fair market value? So again, are you as an owner, are you the operator of the business? Do you pay yourself a fair income? Some people pay themselves very little in W-2 income, and some people overpay themselves for purposes, again, of adjusting for succession. So you want to make sure that it reflects how someone else would be acquiring you and paying the general manager. Rule of thumb in peer groups is $250,000. If you're over $250,000 in paying the owner, you need to think about, does it really cost that much to employ a general manager to run that operation? Whatever it might be is fine. You just need to know what that would be. And then lastly, are there other expenses in the business that would not be there if a new owner took over, i.e. you have a pet project that you like to fund, you have season tickets for something that benefits you and your family as well as the business, and of course, family expenses that run through the business that would not typically be there. So those are considerations. So then we're going to determine the latest multiplier. And really, adjusted EBITDA is supposed to represent free cash flow. So if someone was to buy the company, how long would it take them to pay back a loan for the amount? So 3 to 4 years is a good rule of thumb for any type of business. And again, if you're getting a professional valuation done, it might be different. But for now, you're just going to kind of manage what is the value of the cash flow inside the company. So 4 times is fair. If you have more locations or unique services such as specialty rental, you consider a bump in the multiplier. If you have old inventory or you're flat and you have no growth, then you might want to consider that bumping down that multiplier. So maybe like a 3 times EBITDA. And again, if you're in specialty rental services, you might be at a 5 or 6 times EBITDA. So what does that mean? So I'm doing $2 million in sales. My net profit is 10% or $200,000. I'm going to add back the EBITDA to get it to EBITDA, right? So I'm going to look at my interest expense for financing. I'm going to look at depreciation of my rental assets and other assets. And I'm also going to look at amortization expenses. I've done some leasehold improvements recently, and I'm going to expense them over 5 years, not take it all in 1 year. So I need to add back that leasehold improvement amortization expense. And then I may have some additional tax expenses, not corporate tax, that would be added back in as well. So you can see that the net profit moves to an EBITDA of $500,000. So from 200 to $500,000. And then I'm going to make a couple more adjustments. One is I'm buying out my parents, so there's $50,000 a year of additional rent and $50,000 of additional W-2 income. My mom doesn't work in the business, and I pay her a salary, yada, yada, blah, blah, blah. So my adjusted EBITDA is actually 30% of sales, which is 600 grand. I'm going to go ahead and multiply that by 4, and that's going to give me my valuation, 2.4. So that's it. So that's basically how you do your valuation yourself every year. It's pretty basic. You can actually write this into your buy-sell agreement. You can use it for phantom stock with your employees. A lot of good things you can do with your valuation. Most importantly, look at your personal balance sheet and look at the value of your company on it. However, there are other considerations, premiums or discounts. Is my company really only worth 2.4 million, or is it worth more than that? So these are some questions you need to look at and consider and ask yourself. And if you answer them in a positive way, you may have more of a higher value in your company. If you answer them in a negative way, you may have to put a discount on the value of your company. So by all means, contact us if any of this is interesting and you want to get into a professional valuation. Obviously, you have a significant discount. I think it's 75% discount if you're a peer group member to get your valuation done. So contact us today if you need that.